So we're at learning objective 3, and we're going to just go through a bunch of revenue recognition issues. The first one, sales returns and allowances. So we all know what a sales return and allowance is, and the update as a result of the new revenue recognition standard is that we have to know that sales returns and allowances are not separate performance obligations, but they are part of determining the transaction price. So it just reduces the amount of consideration that they expect to receive on the transaction. So when we estimate the returns, you're going to record a refund liability, and we're also going to add back the estimated returns to an estimated inventory account. I think the easiest way to do this is to look at an example and just see what happens here. Okay, so I'm just using the one from the book. The company sells 100 cameras on account, $100 each. Now when they update the textbook, who buys cameras anymore? Well, I have one here, but I didn't buy it, but you know, everyone's just using their phones. So anyway, but they bought they sold 100 cameras, $100 on account. So you do your usual accounts receivable and sales revenue. You book the cost of goods sold and inventory. And then on the 25th, there's some actual sales returns and allowances. Now this is no different than we did in AC 102. It just goes sales returns and allowances, accounts receivable. This is for the selling price, and then we put it back into inventory at the cost. And it's just returned inventory, and we reduce our cost of goods sold. Now, at the end of the period though, what you're going to do is, it says they estimate that 3 cameras altogether are going to be returned. And so at the end of the period, we're going to have to estimate, well, of those we think are going to be returned, how many more are still out there waiting to be returned. So what we do is we would go sales returns and allowances, and then we would use this account allowance for sales returns and allowances. Because this other camera that hasn't been returned yet, you can't reduce the accounts receivable because it hasn't not been returned. I don't know if even that makes any sense. So we use this allowance for sales returns and allowances, and we put it right into the sales returns and allowance account. So, and then we do estimated inventory returns. It has not been returned yet, and we reduce our cost of goods sold. All right, so what's up with this allowance for sales returns and allowance? It's a contra account to accounts receivable. Okay, so your basic steps on this, you just book your sales and your accounts receivable. You've got your regular returns and allowances. You do this. This is nothing new here. This is all the same. The only thing new is that at the end of the period, we're going to estimate how many future returns we're going to have, and we're going to debit our sales returns and allowances for those estimated ones, and use this allowance for sales returns and allowance accounts, and then the estimated inventory returns. Okay, so there's that one. So this is if it's a credit sale. Oh, let's look at how that would be on the income statement. You'd have your sales revenue less your sales returns and allowance, and that's going to include the 200 actually returned plus the 100 estimated to be returned. So then you've got your cost of goods sold, your accounts receivable are going to be the 9,800, less your allowance for sales returns and allowance, your future estimated returns. So, and then you have your returned inventory of 180. Okay, so it's a little bit different when you have cash sales with returns and allowances. It's the same principle involved, but obviously you're getting cash instead of an accounts receivable. When there is a sales return and allowance, an actual one, it would be either accounts payable or cash. That would be the credit there. And the sales returns and allowances estimated would actually increase your accounts payable. Okay, so you have to work through a couple of those so that you get them all down. Okay, so that's That's it for our sales returns and allowances.